And good morning, everyone. It is truly an honor to join you here in Shanghai today, and I want to express my deep appreciation to Marine Money for hosting this invaluable gathering of minds. After participating in the discussions in Greece just weeks ago, I am reminded of how essential forums like this are for driving our industry forward. Today's presentation is titled, Must What Goes Up, Come Down? A summary of dry bulk and tanker markets. In it, I aim to explore a pressing question. Are today's asset values and charter rates sustainable, or are we on the brink of a market correction? Through this analysis, I'll highlight how current market forces, unlike past cycles, create a unique landscape for opportunities and risks. As we move forward, we'll dissect the key drivers behind the tanker and dry bulk markets, including asset pricing, fleet demographics, and the profound impact of geopolitical developments. With the US elections unfolding today, we find ourselves at a pivotal moment where shifts in global trade policies and political strategies could significantly reshape our industry's landscape. I'll begin with a look at how today's market compares with the past, examining the structural changes that make this moment distinctive, before we delve into our data and its implications for what lies ahead. So the tanker market is experiencing robust growth, underpinned by the Russia-Ukraine conflict and disruptions around the Red Sea, which have ultimately altered trade routes and extended voyage distances, creating increasing ton-mile demand, freight rates, and asset prices. In contrast, the dry bulk sector, while affected by the same global events, has shown a more modest response. Russian cargo flows through the canal have been a notable development, with Russian traffic contributing up to a third of total dry bulk transits over the past 3 years. Another factor supporting dry bulk demand has been the Panama Canal, especially in Q1, as East Coast South America played a major role in this year's freight rally. As we look to the future, one question that dominates is whether the market can sustain these elevated asset values and charter rates. During the first half of the year, the sustainability of the market was a hot topic, especially in light of discussions at Posidonia, where concerns about a repeat of the 2008 and 2009 downturn were prominent. While some market softening may occur, today's market structure shows key differences from past cycles. The order book comparison graphs illustrate a more balanced approach. The current order book to fleet ratio is far below past peaks, reducing the risk of oversupply that once drove severe corrections. In tankers, fleet renewal outweighs expansion, while in dry bulk, ordering is selective, especially among larger vessels. This measured approach suggests that even with gradual order book increases, neither the tanker nor the dry bulk markets are likely headed for dramatic downturns, thanks to a more cautious fleet management strategy. I'll begin with a brief overview of the current fleet growth and aging trends. From there, we'll look at the new building and order book patterns driving these changes, and finally, we'll explore what these dynamics mean for the sale and purchase market. We begin with some projections based on the current delivery schedule for 2025 and 2026 and estimated for 2027. Over the same period, we consider demolition activity at the lowest, average, and highest rates seen in the previous 10 years. Starting with the tanker sector, a look at the current fleet demographics reveals a significant portion of the fleet is nearing the end of its operational life, an issue which raises important questions about future scrapping and new build demand. When looking at the table data, it is evident that MR scrapping must accelerate to prevent oversupply and potential downward pressure on rates. Aframax and Suezmax fleets could also face oversupply risks if scrapping rates do not increase. On the other hand, the VLCC segment presents a more stable outlook with moderate growth potential, even in low scrapping scenario. The combination of a modest order book and the operational longevity of VLCCs reduces the likelihood of a dramatic market disruption, suggesting a more resilient structure in this asset class. Moving on to the next slide, the aging of the tanker fleet is inevitable, and we anticipate that a large share of the fleet will eventually be retired. MRs in particular face immediate pressures, with nearly a quarter of the fleet reaching or exceeding 20 years of age. Aframaxes will also need a sustained rate of recycling to avoid the high proportion of older vessels, which could create fleet inefficiencies. In contrast, Suezmax and VLCC tankers have comparatively fewer aging pressures, thanks to a lower order book and reduced deliveries. Turning to dry bulk, our assumptions reveal a younger fleet profile. The charts and tables that follow show that fleet growth rates have notably increased this year for geared bulkers, and this trend is expected to continue into 2025. Deliveries next year are said to be the highest in a decade, with Kamsarmax additions projected to hold steady through 2026, potentially driving a 3 to 4% fleet growth if demolition rates remain low. However, moderate or slightly above average scrapping could effectively moderate growth even if shipping demand softens. The Capesize story is different. Recent years have shown a slowdown, with limited deliveries expected over the next 2 years, keeping fleet growth below 2%, even with minimal scrapping. However, strong newbuilding contracts in 2024 could push growth up from late 2026 onwards. Turning to fleet age, the dry bulk sector presents a stark contrast to tankers. Vessels 20 years and older should remain at or below 20%, a figure which is manageable with scrapping rates in line with past decade averages. However, vintage tonnage has steadily increased across most sectors since 2014-2015, except for Capesizes, where the vintage proportion dropped from 2007 through 2021. A notable underlying factor is the high percentage of vessels nearing the 15-year mark, creating a relatively modern fleet now. However, entering the 2030s, a significant share will reach 20-plus years of age, similar to the current tanker fleet. For instance, the number of Capes aged 10 to 15 years almost matches those under 10 years, signaling an approaching age shift. Now, looking at newbuilding asset prices, the steady surge since 2021 is striking, nearing the record highs of the previous super cycle. Remarkably, this price increase persists despite ample shipyard capacity, largely driven by strong contracting and limited early delivery slots, especially at leading yards in China and South Korea. Tanker contracting remains robust, supported by solid crude and product tanker markets and an aging global fleet, pushing the order book to around 12% of the current fleet, which is 3 times higher than back in October 2022. In dry bulk, Capesize orders have dominated contracting activity, even with newbuilding prices up by 12% this year only. However, sub-Cape vessels have seen less demand as owners take a cautious approach, with dry bulk contracting down more than 25% from 2023 levels. So the current shipbuilding landscape reveals a notable trend. Production power is concentrated in fewer yards, with Chinese shipyards especially expanding capacity to meet rising demand. While order growth clearly drives this increase, other factors are at play as well. Newbuilding prices continue to rise, not just from demand, but from several cost pressures. Steel prices remain high, labor costs are up, and ship designs have themselves become more complex with energy-saving technologies and dual fuel engines. Even as material costs fluctuate, these factors will likely keep prices elevated for the foreseeable future. Looking ahead, fleet renewal isn't merely expected, it's essential. Many vessels from the early 2000s are reaching retirement, and upcoming decarbonization regulations add urgency to fleet updates. Although prices may stabilize, managing shipyard capacity effectively will be crucial to balancing deliveries and meeting demand. The bar charts on the slides clearly show how delivery times have extended in recent years. What once took 2 years now often takes 2 to 3 years, a trend which is unlikely to reverse soon. So turning to how these trends play out in the SNP market, we noticed that tanker sell and purchase activity in 2024 has decreased compared to recent years, with 367 vessels sold this year so far, a noticeable drop. Starting with VLCCs, younger tonnage remains strong, with 49 sales recorded, though down from 81 sales last year. Chinese buyers have led, acquiring 21% of sales as they expand their fleet for oil logistics control. Greek buyers also remain active, but are more selective this year. Prices for modern VLCCs reflect strong demand, with 5-year-old vessels priced at around 116 million, which is a 47% increase above the 5-year average. On the other hand, buying appetite for Suezmaxes has been softer, with 21 vessels sold this year. In this segment, buying interest remains focused on the vintage class, which is absolutely reasonable if you think that 40% of Suezmaxes are operating in shadow markets today. In the Aframax market, 64 vessels have been sold in 2024. Though volumes are lower than last year, Southeast Asian buyers from Malaysia, Indonesia, and Vietnam have driven interest due to increased fuel demand and regional refining growth, where Aframaxes shoot shorter routes. Demand for older vessels, often joining shadow fleets, has kept values stable. A 10-year-old Aframax, for example, saw a 14.5% price increase this past year. The MR tanker market has been particularly active, making up almost half of all tanker sales in 2024. Greek buyers alone have acquired 21 vessels, with further interest from Asia, especially China and Singapore. Rising demand for younger MRs has sharply pushed prices up, with a 10-year-old vessel appreciating by 27% year on year, and 5 to 10-year-old vessels now being 60 to 70% above their 5-year average price. In the dry bulk S&P market, the strength of the charter market this year has fueled significant activity, especially in the Capesize sector. The Baltic Capesize Index has notably outperformed the broader BDI, and asset prices have reflected this resilience. February alone saw over 90 dry bulk transactions, the highest monthly total since 2021, leading to a rapid asset value increase. For example, a 10-year-old Capesize that sold for around 30 million back in September 2023 was trading at 36 million by January, and recently at 43 million. Kamsarmaxes also experienced price swings, with values rising and then correcting by 10 to 15% over the year, reflecting both initial strong demand and summer's softer charter market. This correction was expected, as break-even for a 5-year-old Kamsarmax at summer prices would have required around $16,000 per day with 65% leverage, significantly above typical earnings. On a separate note, older Chinese-built Supramaxes have maintained values despite overall market softening, driven by exceptional steel export volumes from China and their suitability for carrying steel coils, a characteristic that has made these vessels popular compared to Japanese tonnage in a softening market. So this overview pretty much captures the market trends that we have been observing. However, it is worth asking, will these elevated levels be sustained, or are they due for correction? As we assess the global shipping market, we're fortunate enough to witness extraordinary returns. While forecasts indicate a continuation of these strong market conditions, we don't foresee a crash comparable to 2008. That said, however, history shows us that shifts can occur quickly. In the Red Sea, the situation remains both supportive and concerning for tankers. Rerouted traffic has temporarily lifted rates, but recent escalations following Iran's missile attack on Israel have raised fears of a broader conflict. A potential Strait of Hormuz closure could drive oil prices upwards and tanker rates higher initially, though a prolonged closure risks oversupply and rate declines. However, we believe that the tanker sector is better positioned today than what it was back in 2009. OPEC's proactive adjustments to balance supply, along with US sanctions on major producers and strategic use of the SPR, have helped stabilize both supply and tanker rates. The Ukraine conflict, on the other hand, has significantly altered the dry bulk sector, as grain imports now rely on distant suppliers like South America and the US, resulting in an increase in ton-mile demand and elevated freight rates. This market, however, remains overshadowed by the persistent uncertainty of the conflict. If tensions were to escalate further, potentially leading to Black Sea port closures or intensified regional military activity, we would likely witness a considerable surge in rates across both tanker and bulk carrier markets. Conversely, a peaceful resolution would restore typical trade flows, effectively reducing current inefficiencies and diminishing ton-mile demand. For dry bulk, the resumption of Ukraine exports would alleviate pressure on global grain supplies, potentially softening rates, while tankers could experience a decline in long-haul Russian oil routes, restoring standard trade patterns and in turn potentially stabilizing or lowering rates. However, today, all eyes are fixed on the US election results, a pivotal moment that could reshape the very foundation of our industry. Depending on who takes office, we may either face intensified challenges or seize new opportunities, each with far-reaching consequences for global trade and shipping. A Trump victory would likely usher in a new renewed wave of protectionist policies, profoundly impacting US-China trade relations and setting a challenging landscape for the shipping industry. Higher tariffs on US agricultural exports could drive China to increasingly source commodities like soybeans and grains from South America, thereby reducing US export volumes to Asia. This shift would weaken demand for Panamax and Supramax vessels on trans-Pacific routes. In contrast, the tanker market may experience a different set of dynamics. A Trump administration is expected to intensify sanctions in Iran, likely disrupting sanctioned oil flows and creating opportunities for non-sanctioned VLCCs to fill the gap. However, this increased demand could be tempered by elevated operational and insurance risks, as heightened Middle Eastern tensions add volatility along key routes like the Strait of Hormuz. Under a Harris-led administration, on the other hand, we can anticipate a shift towards trade stabilization, marked by efforts to de-escalate tensions with China and implement policies that promote US exports. Such an environment would likely enhance the steady flow of US exports to Asia, boosting dry bulk demand, especially for Panamaxes. In the tanker market, Harris' anticipated emphasis on environmental regulations would likely place a premium on eco-efficient, compliant tonnage, driving a gradual transition towards greener operations. This regulatory momentum may also expedite the retirement of older, non-compliant tankers, thereby tightening fleet supply and potentially supporting stable rates for modern vessels. Let's now turn our attention to trade flows, as shown in the following slide, which quantifies the recent impact of these shifting trade patterns on sailing distances and ton miles. In 2023, sanctions on Russia and geopolitical shifts led to a 3.1% increase in average sailing distances. With ongoing conflicts in the Red Sea, 2024 is projected to see an even greater increase of 5.3%. When we factor in volume growth, this has meant a total ton-mile increase of 5.5% for 2023, with expectations of a 5.9% rise in 2024. The critical question, though, is what will happen next? If current geopolitical factors ease, allowing trade routes and sailing distances to revert to previous levels, while volume grows modestly by around 1.4%, we could face a substantial drop in demand, with ton miles potentially decreasing by 7.3%. Applying a similar high-level analysis across the dry bulk fleet, we observe a moderate response in sailing distances, with Red Sea and Panama Canal disruptions proving more impactful than the effects of sanctions from the Ukraine conflict. Our data indicates modest volume growth for 2023 and 2024, driving an estimated 6% annual increase in ton-mile demand, despite the less pronounced rise in sailing distances compared to tankers. However, in a dramatic worst-case demand scenario, where all trade inefficiencies of the past 2 years are resolved overnight, highly impossible, dry bulk ton-mile demand could decrease by around 2%. It's important to note here that we're assuming volume growth remains steady at an average of 3.5% next year. So, as we conclude, I'd like to emphasize the importance of events like this for our industry. They provide a unique forum for collaboration, knowledge sharing, and strategic insights, elements which are critical to advancing the shipping sector as a whole. A special thank you to Kevin and Andrew for their gracious hospitality here in Shanghai, making these gatherings possible and impactful. Thank you all for your attention. 谢谢。